Well, with so much action already, Jeffrey Roach, the chief economist at LPL Financial, is joining me now to break it all down, of course, what it means for us and investors. Jeffrey, it's great to have you on the show this morning. And what do you make of the current state of the economy?
Well, good morning. There's certainly a lot of mixed data, but overall, the sentiment is fairly positive. That's certainly good news for retailers as consumers enter the holiday sales. But it's a little bit confusing, right? There's a little bit of an uptick from the recent continuing claims numbers, and of course the distortions from the latest non-farm payroll report. But outside of that, consumer spending is holding up. Businesses appear to be well poised to enter 2025 with some pretty strong demand for capital expenditures. And of course, the Fed managing through data revisions amid their data dependency mantra.
So we see a bit of a mixed market this morning, Jeffrey. We are awaiting the market open here at the stock exchange, but the S&P, the NASDAQ looking to extend the gains from yesterday. Both of those indexes up fractionally this morning. It does come after tariff pledges from President-elect Donald Trump last night. How should we be thinking about the tariffs that the President-elect shared with us yesterday?
Well, I think it's one of those things, we're used to the phrase speak softly and carry a big stick. The president-elect does not do the speak softly component. But I think markets are starting to interpret his rhetoric in light of that it's rhetoric. It's conversation starters with negotiating with our trade partners. I think the folks that are coming into the new administration, particularly the one poised there for the Treasury Secretary, I think is adding a little bit of voice to reason. And the idea that, yes, tariffs are a tax. At the end of the day, taxes always create some kind of deadweight loss between buyers and sellers. But I don't think that businesses should respond to all of the rhetoric, and it probably will be similar to what we saw in 2018. And it's really important for investors to remember 2018 tariffs certainly impacted producer prices, but actually we saw CPI, consumer prices, actually fall throughout 2018 and into 2019.
I do want to talk about the state of the consumer, Jeffrey, because we've seen some positive earnings results, notably from NYSE listed companies, Abercrombie, Dick's Sporting Goods, just to name a few this morning. Walmart, of course, last week as well. The consumer seems to be pretty strong heading into the holidays. Is that how you see it?
Well, certainly the middle income and upper income consumers are doing fine. And I like to remind folks, it's very different experience if you refinanced your house in 2021 and holding a very low rate on your mortgage. That's a very different experience than if you're a renter. So as we go into the holiday sales season, I expect the consumer spending component to be supported by certainly those middle and upper income households.
And in terms of how Americans should be budgeting for the year ahead, Jeffrey, what would you tell them as they turn to their own planning with 2025 approaching?
Well, overall, we do think rates will drop in 2025. Eventually we need to talk about the Fed. That's still the elephant in the room here. And I think we can expect across the board rates a little bit lower. Probably not as low as we thought maybe 2 months ago, but certainly 2025 will be a year where rates are going to be lower by the end of the year than where rates are as we start the year.
What do you think this means for stocks, Jeff?
Well, valuations are still pretty rich. And so, a lot of this is driven by the artificial intelligence craze. I think we still have a little bit more room to run in general as we think about we're in the early innings of the artificial intelligence game. Perhaps specific names might not continue running as richly as they were in the last year. But I think you add a little more demand from CapEx. As I mentioned earlier, businesses seem to be well poised to start spending for capital expenditures in 2025. That's certainly going to support the markets next year.
I want to ask you about inflation as well, because we will get a read on inflation this week. The Fed's preferred inflation gauge, that is the PCE index, of course, as we digest what President-elect Donald Trump has said specifically about tariffs and some of the action that we've heard from companies. What is your expectation for inflation?
Well, I think we'll get a little bit of a head fake this week when we get the data. So, the Fed focuses on 12-month or annual changes in inflation. And you remember from October last year, we had some pretty big declines in energy. So I think because of base effects, we might have a little bit of an uptick on the annual rate. I don't think that'll change the overall trend, though. The trend of inflation is downward. I think the Fed is actually spot on saying the risks are fairly balanced, but they do need to be very, very careful on the labor side of things. But at this point, yes, we'll have a little bit of choppiness in the read here, but we know that housing inflation will eventually ease up a little bit more as we enter into 2025. And then we're starting to see a little bit of an ease up in professional services, financial services, and insurance. We're starting to see a little bit of that easing up as well.
Jeffrey Roach, Chief Economist at LPL Financial. Jeffrey, thank you. He'll rejoin us after the stock market opens virtually. I want to bring back in Jeffrey Roach, Chief Economist at LPL Financial. Jeffrey, it's good to see you, and we see stocks across the board pretty much higher. The Dow underperforming a little bit, but those small caps certainly adding to a new record yesterday, up 1.5% on the Russell 2000 at the open. We've been talking about the retail space, the travel space, what we can expect these holidays, and I'm curious to hear from you too, given the data endpoints, how you think this might impact Fed policy ahead.
Well, the strength of the economy, both in the corporate sector as well as the consumer space, is giving a little bit of heartburn for the Fed. I think they got over their skis a little bit with a very aggressive 50 basis point cut to start this cutting cycle back in September. I think we're probably going to see a cut either December or January, and then we'll see a few meetings where they pause, just wait and see. I think at this point they'll probably revise their forecasts. As investors know, they release the summary of economic projections periodically throughout the years. We're going to get an update in the December meeting, and I think they're most likely going to revise up their growth forecasts, perhaps revise up their inflation forecasts, and we're going to have to see how they respond. We'll get a little bit of insights when we get the minutes in just a little bit from their most recent meeting. But they're in a tough spot right now because inflation has not eased and the economy has not cooled as fast as they expected, perhaps even just a few months ago.
We'll be watching those minutes closely. Of course, we'll cover them on tomorrow's show at 9 a.m. Eastern. And in terms of the small caps, Jeffrey, again, that Russell 2000 index hitting its first all-time high since 2021, pre-inflation yesterday. Those stocks extending their gains. Last I checked, up 1.5% on the Russell 2000 at the open. What kind of environment is now set up for some of these smaller companies that we had seen underperform during the first 2 years of this bull market?
Right. I think the small cap space is trying to figure out how much of the strength in the economy will continue for 2025. I think the fact that we've had some upward surprises in the economic data has certainly supported small caps. As you know, small caps are very sensitive to growth metrics, and if growth is surprising to the upside, that's certainly a good thing for small caps.
I'm Jeffrey Roach, Chief Economist at LPL Financial. Jeffrey, great to see you, and thanks so much for your insight.
Thank you.